I'm running my double Ferris wheel strategy on NVDA, and this week one of my positions, the covered call, went in the money. That left me with a big decision. Should I accept assignment, roll it straight out, or roll it up? There's merit to all three choices, but I went with the safest option for the most downside protection. Watch and see how I handled it. With NVIDIA trading at $189 and a few cents right now, my cash secured put is well out of the money, and my covered call expiring today is in the money by about $4 a share. So there are several good possibilities for ways to manage this trade. I could try to roll the call up to a higher strike price to potentially capture more capital gains when I accept assignment. I could also just accept assignment today and let these shares be called away from me, or I can roll it out for more income. With the $170 put, I can roll it straight out, or I can roll it straight up for more income. Let's take a look at the options chain and see what the prices look like for next week. Closing the $170 put, if I roll it, will cost me about $2, and closing the $185 call will cost about $415. The October 10th prices for these same options would be about $33 income I could receive for the $170 put, and if I keep the same strike price of $185 for the call, I can bring in about $600, giving me a net credit of a little less than $200. If I roll the call up, I would receive a negligible net credit, but I would potentially receive $250 in capital gains if I accept assignment next week at $187.50. Let's take a look at the order form. Let's start with the call because it is the more complicated decision. I'm Patricia Saylor with Saylor Financial Fundamentals. Lately, I've been getting a lot of requests for one-on-one coaching, and I've really enjoyed meeting new clients. I fit those sessions in between the swimming lessons and tutoring I offer to local children. Swimming lessons are all about keeping my little students safe in the water, and coaching is about keeping you safe in the market. Safety seems to be a theme for me. If you'd like help understanding how options work or how to trade with less risk and keep your head above water, check out my website. You'll find ways to set up individual consultations, plus free and premium resources to support your investing journey. If I roll it straight out 1 week, I can receive between $195 and $202 for it. If I roll it up by $2.50 a share, I can receive between $25 and $35. Rolling straight out and keeping the $185 strike is the most conservative choice for this roll because it keeps it in the money and gives me more protection if the share price pulls back. So I am going to go ahead and make that choice. And let's take a quick peek to see exactly how much income I received for it. Looks like it filled at $205, giving me a net credit of $203.68. In order to calculate my annualized returns, I'm going to use 185 times 100 as my collateral value. $18,500 is what those shares right now are worth to me. Even though the share price is $188.92, if I choose the do nothing route, they would be called away from me and I would receive $18,500 at the end of the day. So rather than receiving $18,500, I'm rolling it out 1 week and receiving $203.68 for an annualized rate of return of 57.41%. This position is now closed. And now let's go ahead and roll out the cash secured put. You notice last week when the share price was $176.21, I received $115 and some change for rolling this put out. But now that the share price has increased, I'm going to get a lot less for the roll for the put, but I received more income for the call. So I've clicked on the position, roll selected, and a straight roll, keeping the same strike price of $170 will bring me about $31 or $32. And just because I'm curious, I'm going to see what I could receive if I rolled it up $5 a share. I could get a little bit more income by increasing the strike price to $175, but I think I'm going to just keep it at $170. The order filled at 32 cents a share. So the put that's expiring today is now closed. I still am using $17,000 of collateral and a $31.33 return in 7 days gives me an annualized rate of return of 9.61%. So if we compare this to last week, when we rolled both positions out of the money, we got a higher rate of return on the put and a lower rate of return on the covered call. But this week, because the call has gone in the money, I have a higher rate of return on the call and a lower rate of return on the put. But I kept the same strike price for both of them, mainly because it just gives me a little more downside protection. There are a lot of ways I could have handled this, this roll and this trade adjustment, but because the share price of NVIDIA has increased so much this week, I am prioritizing a little bit of downside protection by just rolling the call in the money and keeping the same strike price for the put. But my income was still pretty good this week. Let's do a quick sum. Going all the way back to August 1st. In the last 3 months, I have bought shares, and then all of my other trades have been options income. I haven't allowed assignment to buy or sell any shares. So at this point, my total out of pocket is $24,023.47. I still have 150 shares, which brings my average cost per share down to $160.15. The net liquidating value of the position, $27,713. And if I total up my expense and income compared to the net liquidating value, you can see that this week the position overall is up more than $3,600. So I'll see you next week on October 10th, and we'll see how these two contracts play out.